Hello, dear friends and investors. Welcome to our monthly video on markets and investing. Today, we are going to talk about a few interesting things and topics which are very much at the top of the mind of investors. We've had some very good events happen over the last few weeks in India in the IPO markets. But before we get there, let's talk about what's happening in this current earnings season in Q1. Now, as you know, that it just turned out that the Q1 of last year was significantly impacted by the first wave and large lockdowns. And similarly, the Q1 of this financial year 21-22 was also significantly impacted by the second wave and selective lockdowns that we saw. Having said that, I'm sure that all of you would have seen the results of several companies that are underway right now for the first quarter ending June, that most businesses, though, have seen a quarter-on-quarter fall between the fourth quarter last year to the first quarter this year, and that is quite obvious because usually for many companies, Q4 is a very big quarter in the full financial year, but also it was a quarter where things had substantially opened up and we had great momentum across industries because we had relatively, the second wave had not yet started by then. And therefore, comparing this year quarter one results to last year's quarter one results is actually not very comparable, right? Because last year was very depressed. This year, even though we had the second wave, most businesses have been able to manage the situation reasonably well. And therefore, it is quite instructive that how do we compare or assess whether earnings growth of companies is on track. And why is this important? This is very important to assess because there is a general feeling, and we've discussed about this in our previous videos, that the markets are very expensive. And when markets are expensive, what investors are always looking out is their earnings growth, and therefore, is the rally in the market sustainable? Does it have any fundamental foundation? And therefore, it is very important at regular intervals for us to do a rain check on how the corporate sector in general is behaving. And therefore, I think what is more instructive is to actually compare the 2-year CAGR, which means that you look at the kind of growth companies have done both in revenue and profits from 2019 to 2021, right? So if you take a 2-year CAGR, it tells you whether we are making progress or not. And obviously, as I said, both in 2021 and 2021-22, in the first quarter, companies have had to manage the COVID situation. And if we look at the numbers, I think out of the total 50 companies in the Nifty, currently 43 companies as we speak have come up with their results. And if we look at a 2-year CAGR of revenue growth, we are still at a positive 4%. And if you look at the 2-year CAGR of net profits, then we are up 18%, which means that despite taking a low quarter in Q1 this year, we are still seeing at an aggregate level for about 43 companies that revenue is still growing and profits have grown by 18%, which in my opinion is a reasonably decent number given the challenges that we've seen. And as I have been saying in the past, in the several months prior to this, it is our belief that the bedrock of this rally or the bull market that we are seeing in equities today is not only based on liquidity, but it is firmly based on the fact that the corporate sector is able to withstand this crisis, grow revenues, and grow profits. So if a Q1 is running at a run rate of somewhere about, and if you take about 190 companies, I gave you the data for just the Nifty companies, but if you take a slightly wider universe of, let's say, 190 to 200 companies, even then the revenue growth on a 2-year CAGR is growing at 3%, and the PAT at a 2-year CAGR is growing at about 15%. And I think that if we do not have a significant third wave and disruption, then I won't be surprised if for the full year 22-23, earnings for the Nifty companies and the broader markets should compound or should grow somewhere in the range of 25 to 30%. And believe you me, this will be the second year where earnings have grown reasonably well when it was most unexpected, right? So I think that we continue to look at the market with reasonable optimism. Obviously, the caution comes from the fact that we have started to see a little bit of a euphoria in the IPO markets, and we'll talk about that a little bit later, and a euphoria in many small, low-quality, small and mid-cap stocks as well. But having said that, I think if we have to assess the top 200, top 300 companies which are high quality, I think the earnings growth is very firmly in place. And we think that there are legs to this rally, even though there might be intervening periods where we will see some consolidation or correction. But we continue to be extremely bullish over the next 2 to 3 years, because we believe that we are starting a new economic growth cycle and a new earnings growth cycle in India. Now that we've talked about earnings, let's talk about something which has been very topical over the last few weeks. We've seen India's IPO market completely fired up, right? We are seeing huge successes in the IPO market. There are massive oversubscriptions, and the IPO most of the IPOs are getting a fantastic reception in the IPO market. Now, does this mean that is there a bubble? Well, I have two explanations. One is that usually in the first leg of a rally from an absolute bottom, it usually happens that most investors tend to miss a large part of the rally because they are continuously cautious. And again, we've spoken about this, that ever since Nifty reached 11 to 12,000 last year, people have been waiting for that eternal correction to come to deploy money. And that never came. And therefore, what happens usually is that money shifts to the IPO market, because then there is no reference point for a price of a new company which is listing. And therefore, just psychologically, it is easier for people to bet on new companies at a completely new price. And that's what's been happening in our IPO market. But more importantly, I think we had a turning point with the listing of Zomato. Now, Zomato represents what I would call the new age technologically or digitally powered businesses, which hitherto were largely talked about in venture capital and private equity circles. But now we have secondary market investors having the opportunity to invest in these kind of companies. And Zomato is just the first of the lot. As you all know, that we are likely to see a slew of IPOs that are likely to hit the market. And therefore, there is a lot of excitement amongst investors in wanting to participate in the new economy, the digital economy of India. And over the last few weeks, I have got several calls and messages asking what our view on companies like Zomato would be, and would we be investing in these kind of companies. Now, let me step back and say that, do we see an opportunity are these real businesses? Would we invest in them even if these companies are making losses? The answer is yes, we would look at these companies, even though they are making losses. However, we need to understand that there are certain advantages and disadvantages, right? Our current framework, the way we evaluate companies, does not immediately allow us to invest in companies which are making losses, or where we believe that the runway to make profits can be significantly longer, which means that we have to think about these businesses very differently. So unlikely that we will immediately invest in these businesses in our PMS schemes. Now we have a strategy on an AIF platform. Some of you, I'm sure many of you have heard about it, the Alchemy Leaders of Tomorrow, where our mandate is to invest in disruptive companies of the future. And we want to do it purely in the listed domain. And, we have invested in many what we believe as cutting edge companies, whether they are cutting edge in terms of their digital capabilities, or they are cutting edge because they have great brands and the way they are able to access the market, or they have very differentiated skill sets, or they are going after certain niche markets and doing something very differently than what their competitors are doing. And therefore, we will certainly look at very carefully the opportunity set amongst these many new, internet and digitally powered businesses to invest in our AIF, the Alchemy Leaders of Tomorrow. And if any of you are interested in looking at that, please reach out to your relationship manager and they will explain you about the product. But coming back to Zomato and businesses like that which are getting listed today. Now, what is happening, right? And how should we look at these businesses? Now, if you look at some of the best franchisees across several sectors, there are so many great companies that have been, there in India from time to time. I mean, in financial services, we know of companies like HDFC Bank, Kotak, Bajaj Finance, Cholamandalam Investments, Reliance. In pharmaceuticals, Cipla, Sun Pharma, Dr. Reddy's. If you look at consumer companies, there are so many of these brilliant companies like Nestle, Hindustan Lever. They're all great companies. Asian Paints. Now, it has taken several decades of hard work and persistency to build scale, profitability, and great return on capital and cash flows. These businesses were not built overnight. Many of these businesses have taken decades to build, right? Why has it taken decades? I think one is that the earlier model was that you had an opportunity, you had an entrepreneur who wanted to take advantage of that opportunity. They had to build plants, they had to build distribution network, or if you were in a service business, you had to go and get customers, you had to build your services, you had to show a track record, and it took time for you to go out and penetrate the market and build scale, profitability, and cash flow across business cycles, right? And it's a long, arduous process. It doesn't happen overnight. Some of the best companies, as I mentioned, have taken decades to build. So, what happens now in this new age companies? And I think this trend was first started in Silicon Valley, where there were venture capitalists who were the highest risk takers, or the private equity investors who were the highest risk takers, who were willing to bet on new businesses, new age businesses, and new entrepreneurs who were willing to do things differently, right? Either because they had a technology edge, they had some superior edge or they were trying to solve some very different problem for consumers or B2B businesses. And the venture capitalists said, okay, here is risk capital. You don't have the capital, but you have the opportunity and you have the ability to execute. Here's the money, go out and execute, right? Now, over the last several years, and especially in the last decade or so, we have seen that many companies have reached humongous scale and market cap in a matter of probably a decade and a half, or maybe 2 decades, right? And we've seen the kind of wealth that has been created by companies like Google, Apple, Netflix, recently Tesla, all disruptive new age companies which were doing something very different. Either they were looking at new markets, completely new markets and products and services, and they did it at a global scale. And I think what happened was that there was so much wealth that was created that it has generated a humongous amount of interest in investors across the world, that how do we participate in this wealth creation process. And therefore, we have now these businesses which have reached a certain scale in a very short period of time, going IPO, giving an opportunity for retail investors to participate. So what's different? I think what these businesses are trying to do is that they want to reach scale in a very short period of time. What takes 20 years to build, they're probably trying to do it in 5, 7, 10 years. Now, when you want to build something of significant scale very quickly, obviously you got to spend a lot of money and you got to do it smarter than somebody else is doing. And today, technology is allowing these companies to do things differently, quicker and faster, and achieve scale much more faster. But many times this is happening at the cost of current profitability. Because you want to grow rapidly, because you want to acquire customers rapidly, your cost of acquisition of customers is very, very high. So you're willing to spend today more than what you're earning in order to create that scale and acquire customers much faster in a very short period of time. And that's why these businesses are bleeding and are cash flow negative. This is very different from how we evaluate usual businesses where we look for profitability, cash flow. Now, does that mean that profitability and cash flow is no longer important? No, that's not the reason. I think that in the final analysis, if you look at some of the best companies around the world, even the success stories like an Alphabet, a Netflix, or a Google, ultimately, they all have to make money and cash flows. And that fundamental principle is never going to go away. However, there are a set of investors who are willing to bet that if a company is able to achieve scale very quickly at the cost of current profitability, then over time, these businesses will learn how to make money. Because once you've acquired the customer, then you can start to provide services and products and charge for them so that you become profitable, right? But the initial focus is to just go out and acquire customers. They do not focus on short-term profitability or even medium-term profitability because they want to do it very quickly. Now, the classic example that you will understand is Reliance Jio. What did Reliance do when they entered the telecom industry, right? They decided, we don't want to be profitable initially. My first goal is I want to get to 400 million or 500 million mobile phone subscribers, right? And they kept rates very, very low. Now that pricing was used as a strategy to acquire more and more customers. And it was funded through Reliance's own balance sheet because they had other businesses like their petrochemical refining and oil and gas business, which was generating cash flows. And plus they also borrowed some money, as you all know. And they built out Reliance Jio very quickly in the last couple of years by becoming very disruptive when it came to pricing. And today they are at 400 million plus customers, aspiring to move to almost 500 million customers, 500 million mobile customers, right? And it brought down the profitability of the entire industry, but that is how they played the disruptive game. Now, the bet that Reliance Jio is taking is that now that I've got 500 million customers, I will start selling other services on top to all these 500 million customers, whether it is video, whether it is music, or whether it is e-commerce transactions through JioMart, and I will start earning more and more revenue from that customer by cross-selling services to them. I think that's what many of these businesses which are likely to go IPO are also doing. Their cost of acquisition of a customer today is very high. They want to acquire these customers very rapidly in a very short period of time. Once they achieve scale, then they will figure out how they want to charge the customers and how they want to become profitable. Now, let me therefore say, what are the pluses and minuses of investing in these kind of businesses, right? The first positive is obviously fast growth. And as you all know, markets love growth. They're willing to give a higher valuation to companies which are consistently growing faster. And how fast? I mean, if you look at it, let's say if Indian GDP compounds at 12% in nominal terms, many of these businesses are growing at a factor of 2, 3, 4x nominal GDP. They're compounding at 30-40% a year, which means that they're growing 3 times faster than nominal GDP. Second, the positive is that most likely many of these businesses are aspiring to achieve scale very quickly, very fast. Third, they are disruptive, which means that they have some edge where they may be disrupting an existing old business model to achieve this scale far more quickly. And fourth is that you have the ability to bet on new entrepreneurs who are very bold, who are risk-taking. There is fresh blood coming in, and you want to possibly be part of this new economy where companies are growing faster, they are more disruptive, they're led by great entrepreneurs who are willing to take risks. What is therefore the downside of something like this? One is that you will find that many of these businesses are constantly evolving, right? So it's not that you have some great visibility. They need to keep changing their business very often to make money. So for example, let's take the example of Zomato. When Zomato started life, it started as a pure restaurant listing and review website, right? So if somebody visited a restaurant they liked, they wrote a review, and hence anybody else who wanted to go to that restaurant would go to the website, would read the review, and then decide whether they wanted to go or not, right? Now, they have changed their business several times. That's how they started. But today, they've become a food delivery company, right? Now, today, they're delivering food. Tomorrow, their aspiration would be that I would want to deliver grocery to the same customer. Day after tomorrow, they may have an aspiration to deliver medicines to the same customer. Now, whether the customer will go to them or will go to somebody else, that's a different question. That's a bigger debate. But the business models are constantly evolving. And therefore, unlike the more established businesses that we bet on, you don't have visibility because there is constant evolution of the business. Secondly, the cash flows will take significantly longer to come, which means that, as I mentioned, these companies are willing to have cash burn because there are investors which at every stage of their life cycle were willing to give them more and more money so that they can go on that customer acquisition spree. Having said that, we also need to keep in mind that because these are new businesses and even we are trying to keep pace to understand what they are doing, even the governments and the regulatory environment also takes time to understand what these businesses are doing, right? And therefore, maybe in the initial phase, these companies grow very rapidly. They are unregulated, but over time, when they become very big, or they start to have monopolistic pricing power, you can be sure that there will be regulatory, there will be regulatory scrutiny of these businesses. And we are seeing that you would have read about what's happening in China. There has been a crackdown on the e-commerce companies, on education companies, on fintech companies. They've been restricted from going and listing in the US markets. And why is all of this happening? Obviously, there are certain objectives that governments have in terms of not having monopoly power. They don't want to give away their ability to tax these companies. Many of these companies are, registered in tax havens, so they avoid paying taxes. Or there may be a social agenda. Like in India, for example, after the Flipkarts and the Amazons came in and became very powerful, it started hurting the small traders, the small SMEs. And over time, we've seen that regulations have gone tighter and tighter on e-commerce companies because the government has to take care of consumers. They have to take care of other stakeholders. And therefore, there is always a sword of tighter regulations that may come in much later into the life cycle of these companies. So that's a risk that we need to keep in mind, right? So the first risk, as I said, is that the business is constantly evolving. Second is that it may take a very long period of time before these companies become profitable and start earning cash flows. Third is that there will be a regulatory risk which will come in. Fourth, I think once you have that kind of success and valuations, be sure that there will be more and more supply of paper in the markets, right? A lot of other companies would say, hey, if Zomato can get this valuations, why not me? And you will see a slew of these companies coming to the markets. So supply, right now, there are very few companies. So there is a lot of excitement. Many of the early ones will get a premium because so many investors want to participate in the new economy. But over time, there will be so much supply of new paper that I think the extra premium that these companies are getting or the valuations that these companies are getting will dampen over a period of time. And the last point is that it's very important that many of these companies are coming at a valuation which sometimes may leave very little upside for the investors. And in our enthusiasm to participate in the new economy, and because it is so difficult to value these companies today because they don't have profits and cash flows, there could be massive volatility in their stock prices if there were to be a risk event or any of the other issues that I mentioned. For example, how many investors, I want to know, will be patient enough to hold a company which is continually making losses for a long period of time before they start to break even and make money, right? So I think there are positives and there are negatives, and we got to weigh this. Today, it's the Wild West. And this is what I have always called as version 1.0 investing. In version 1.0 investing, everything, if it's a new trend, everything does very well, right? Because it's very difficult to value these businesses. And there is a huge trend which follows. And because you make money in the first few, there is a huge capacity for people to keep betting on these kind of businesses. And then somewhere down the line, reality sets in. We believe that yes, we definitely like many of these businesses which are likely to go IPO. I think they are real companies, they are real businesses, they are at the cutting edge and they are doing something different. But we will do two things. One is that not all new age businesses are likely to be sustainable and successful. Secondly, we want to buy them at the right price, even when they are unprofitable. And we will buy it in a strategy where we tell you that this is a strategy in which we are likely to bet in these kind of companies. So certainly we should not take these new companies not succeed and failed. We only look at the successes. We don't look at how many companies have never been able to scale up and live up to the promise that and the hype that was there. And therefore, our belief is that what has happened is a new era has dawned. It is very positive that today these companies are able to raise capital, risk capital, very important to get our economy up and growing and more risk taking and more entrepreneurs to come in and new businesses to get established. But we need to bet on these companies after thorough understanding of their business models and more importantly, the price at which we want to participate. And believe you me, the markets will always give you a chance. We've seen this, through several market cycles, that markets will give you a chance. The best of companies at some point in time are available at a very attractive price. Just when everybody in the world thought that they wanted to chase the Chinese technology companies because of the massive growth opportunity, etc., and you had this regulatory sword which came, and suddenly all these stocks are down 50-60% from their peak, right? So now, if there are some serious investors, they will always have a chance to look at some of these businesses. And I think in India, it's not going to be any different. The principles of the markets remain the same worldwide. I think you will see many companies get listed. We will study all of them very seriously. And at the right time, at the right valuations, we will participate in them. With this, I end this month's video. Stay healthy until we meet the next time. Thank you.